Statement of Liability for 2024 explained. Hi and welcome to this video guide. Trying to make sense of your statement of liability can be a bit of a head wrecker. So we decided to make this explanatory guide. You will no doubt have noticed all the different panels with a brief description of each. Unfortunately, it can be a bit mind-boggling to understand what many of the panels mean and what type of data could be contained in each without some examples. As we will be going through each section and panel in turn, some or perhaps many of you will become bored and switch off early before getting to the section you are most interested in. For this reason, we decided to create this contents page with the description of the section and the minute and second mark that it begins. In this way, you can use it as a reference and be able to return to it again as you please. What is a statement of liability? A statement of liability is the new name for the revenue statement that was previously called a P21 balancing statement. A statement of liability is a statement of total income, tax credits and tax paid for a particular tax year. For people in paid employment who pay all of their income tax under PAYE or pay as you earn. You do not automatically receive a statement of liability from revenue, so you must request this document. This video brings you through each step of the process for the request to the full explanation as to what is contained in each panel or section. We here at Payroll Matters in Ireland have now created 3 video guides that show taxpayers how to review their tax for 2024. The first one in the series is how to access and read the preliminary end of year statement. This explains the details contained in it and what PAYE workers have to do next. Here is the link to the video guide. Around this time every year on our Facebook group, Payroll Matters in Ireland, we get several posts every day about preliminary end of year statements and statements of liability, and we answer these in the video. The second video in this series is on completing an income tax return for 2024 and the 3 previous years. The link to this video is here, and this allows you to A. Change existing credits and or declared incomes, B. Declare additional income, for example, rental income, income from casual work, etc. C. Claim additional credits and or reliefs, for example, health expenses. D. Claim any overpayments. And E. Request a statement of liability from revenue, which leads us nicely on to this video guide, which is the third and last one in the series. This video, your statement of liability explained, is the third in the series. The answers to posters' questions like these ones always vary. At this time of the year, there is no one answer that fits all. There can be a variety of reasons why some statements of liability will take longer than others to issue from revenue. We will give more details on these just a little later. Confirmation by email from revenue of income tax return. Once you sign and submit your completed income tax return, you will get a confirmation email like this one, thanking you for submitting your income tax return for 2024. It will tell you that your return will be processed and revenue will contact you again shortly. In this regard, it will ask you to please note that the acknowledgement number below is for your records, like reference number 6505472065. And we'll have this request. Please do not reply to this email. Before I get into the details of your statement of liability, please allow me give a very quick introduction for those of you who have not already heard about Payroll Matters in Ireland. This is Pádraig here from the YouTube channel, Facebook group, Facebook page, Instagram and other social media platforms for all PAYE workers and their employers to ask, get answers and find out about pay, PAYE, income tax returns, public holiday entitlements, universal social charge, pay-related social insurance, pensions, redundancy, week one basis, emergency tax, statements of liability, tax credits, employee and employer statutory rights and obligations, and a myriad of other work and payroll-related issues, all free of charge. The Facebook page, the Facebook group, and this channel are all called Payroll Matters in Ireland, and new members, followers, and subscribers to this channel are always welcome. So, back to our Statement of Liability guide. How long does it take to process a Statement of Liability after submitting an income tax return? As we have outlined in our previous video guides, the single biggest factor contributing to the differences in processing times of Statements of Liability are payments from the Department of Social Protection in 2024. There are, of course, a few other reasons why PAYE taxpayers have to wait longer than others to receive their Statement of Liability. And I mentioned earlier, I will go into these in just a few moments under the section of offsets and reasons for delays in issuing refunds and Statements of Liability. Once you have completed your Pay As You Earn PAYE income tax return, you will receive a Statement of Liability for the year you completed the return. Your Statement of Liability will confirm if you have overpaid income tax or universal social charge, USC, to revenue and are due a refund, underpaid income tax or USC to revenue and how that amount will be collected, or balanced your income tax and USC payments, meaning that there is no amount owed or due to be refunded. All amounts underpaid or overpaid up to €10 will be treated as balanced. Subject to my comment a little earlier, most PAYE taxpayers will be able to view their Statement of Liability approximately 5 days after completing their PAYE income tax return for a given year. You will receive an email to inform you that Revenue have sent you a Statement of Liability and that you have an unread document in the My Documents folder within My Account. The email will look like this one here. See our video here. If you are in any doubt whatsoever about the authenticity of the email of the sender, please always remember that Revenue will never contact you by email, SMS, text message, or phone call to inform you of a tax refund or a bill. We here at Payroll Matters in Ireland urge PAYE taxpayers and our subscribers to remain vigilant against fraud, as it can affect any of us at any time. Our video is called How to Identify Scammers, Fraudulent Emails and Text Messages. To access your Statement of Liability, you must sign in to My Account and complete the two-factor authentication, the 2FA. And this message will be the message you receive regarding the verification code for two-factor authentication. When you click on the Verify code, you will be brought to this screen. If you are a My Account user, please access My Documents to view this certificate in your unread documents. When you have unread documents, you will see this goldy coloured dot in the top left corner. Click on the My Documents folder at the top of the My Documents homepage. Select the specific year folder from the summary screen. In this case, we are going to select 2024. Click View PDF to view your Statement of Liability. Please note that when you access the service from a desktop or mobile device, you may need to amend your browser settings to allow pop-up messages. This will allow you to access your documents. Go to your latest Statement of Liability, click on View PDF. Simply looking at all the calculations and panels would make one's head spin, and that's before you even get to the PAYE result, which is arrived at by taking gross pay taxable, less tax credits, see panel 4 for a breakdown, less tax deducted, see panel 2 for a breakdown, reliefs, see panel 6 for a breakdown, adjustments, see panel A for a breakdown, to arrive at your PAYE result, which could be an overpayment, an underpayment, or balanced. In this case, the result is treated as balanced, as Revenue disregard any underpayments up to a certain amount. The best way I have found to make any sense of all this jargon is to break it down into pieces and explain each piece as we go along, so please bear with me. The first thing you need to look at is your total taxable income. This should be what you confirmed on your income tax return and on panel 1, which I will come to next. Please note that if you were jointly assessed, your combined total taxable income will be shown here. Explanation panels for PAYE Universal Social Charge on your Statements of Liability 2024. Go to the next page and on panel 1 you will see a breakdown. We chose this one because it has employment income, pension income and DSP income all subject to income tax. But as we will see later, they are not all subject to Universal Social Charge. You will also see that the income tax is not deducted at source from the DSP payments, thus the 00 beside income tax deducted. The employer descriptions are inserted and are not real employers. They are just used to demonstrate the layout. In a situation where an employee receives tips directly from customers, the employer is not obliged to operate PAYE. In that case, the tips and gratuities are fully taxable and should be included by the employee in his or her income tax return and would then be included in this section. Obviously, the details on each taxpayer's statements of liability is individual to them. This statement of liability has a section for each spouse. You can easily see the income and tax deducted from each source of income. You will see here that there has been no tax deducted from the DSP illness benefit. An example for a single person is outlined on the bottom picture. The next panel it asks you to look at is panel 3 for any deductions to taxable income prior to the income tax calculation. Deductions from taxable pay prior to the income tax calculation. The most common deduction from taxable pay prior to the income tax calculation are flat rate expenses, as we can see here. Over 800,000 taxpayers were in receipt of these flat rate expenses in 2024. Similar, but not the same, to tax credits, these are money off your tax bill. Flat rate expenses are a job-related tax relief. Nurses, teachers, retail, shop assistants, hospitality sector, staff and many other occupations receive these. They are given at your marginal rate of tax. Marginal rate tax allowances reduce the amount of tax you pay at the standard rate by increasing your tax credits by the amount of the credit at 20%, the standard rate. At the higher rate by increasing the standard rate cut-off point to reduce the amount of income tax taxed at the 40% rate. What all that jargon means is that if you exceed the 40% tax bracket by €300 or more, then €300 worth of flat rate expenses is equal to €120 into your hand every year. If you do not reach the 40% standard rate cut-off point, then €300 worth of flat rate expenses is worth €60 into your hand. Revenue have made changes as to the process for claiming these flat rate expenses. So if you have not already seen it, be sure to watch our recent update relating to these changes here. How to claim or add flat rate expenses tax credit. Tax due on statement of liability. In this example, we are going to go through the income tax and universal social charge calculation in summary. For more details on how your tax and universal social charge is calculated, we have a video here. The PAYE system for all pay-as-you-earn workers explained. We can see here on this statement of liability how the tax was calculated in this case. The basic rate of 20% was charged on the first €42,000, which was the standard rate cut-off point SRCOP for a single person in 2024. The balance of €2,979.30 was charged at 40%. The result is what revenue call the tax due. Tax retained by you, panel 5. Then the statement of liability adds tax retained by you, which could include the withholding tax for interest generated on deposits for private individuals. In your income tax return, you should remember to claim a credit for any additional withholding tax you have suffered during the period. You may qualify for a refund of deposit interest retention tax, DIRT, or to have your deposit interest paid without a deduction of deposit interest rate tax, DIRT or DIRT. If you qualify, you must apply for a refund or exemption. Income tax is charged under Schedule D in respect of a number of sources of income which are classified into 5 separate cases. Income tax is charged under Schedule F on dividends paid and other distributions made by Irish resident companies. See more on this revenue page, notes for guidance. And here is the link or the URL code. Adjustments to income tax due Panel 7A and Panel 7B on your Statement of Liability. Panel 7A decreases tax payable, while Panel 7B will increase tax payable. On this example on 7B, there is an amount of €1,072.17 for an underpayment collected that has increased this person's tax for the year by the amount. It says U/P collected. What is U/P and where would this amount have come from? The answer is, it is an underpayment that revenue are now collecting. It could be from a previous year. If you have a question, please ask revenue about it. We have a video on our channel here called How to Submit and Manage Inquiries on Revenue My Account, a step-by-step guide. Gross tax payable. Gross tax payable is equal to tax due plus the sum of tax retained by you and adjustments at 7B. Rather than just ignoring Panel 7A, we decided not to do this, despite the fact that following extensive searches, we have found no examples of adjustments to reduce your income tax liability for the year of assessment. And the only conclusion, therefore, that we can offer is that 7A covers instances where an overpayment for a previous year was not refunded for the assessable year and is now being corrected. Perhaps there's not very many examples of this, so that's why we couldn't find any. We have already discussed flat rate expenses, and they differ from credits in that they reduce taxable pay prior to applying the 20% and 40% tax rates, whereas tax credits are taken away after this calculation is done. Panel 4, as you can see here, and these examples outline all the tax credits you are receiving in the year of assessment. These credits are taken away or reduce your tax liability. Please note that tax credits are restricted to tax due. Tax credits reduce the amount of tax you pay. You must have paid tax in your employment up to or over the amount specified in the combined total in order to use all of these tax credits. If you have less tax paid than these, you can avail of the tax credits up to this amount. Unused tax credits are not carried forward to the next year. We do not have any definitive examples of where and in which panel the following reliefs are catered for, but would assume they would be included in Panel 6. 1. Benefit in kind tax relief for battery electric vehicles and chargers. 2. Remote working relief. Pay as you earn employees. 3. Income tax relief for contributions paid to permanent health benefit schemes, allowable in accordance with Section 471 of the Tax Consolidated Act 1997. 4. Tax relief on donations to approved bodies, Section 848A of the Taxes Consolidation Act 1997, TCA 997, provides for a scheme for this relief. 5. Tax relief to individuals who have incurred costs in employing a person to take care of himself or herself, or a spouse or a relative in certain circumstances. Section 467 of the Taxes Consolidation Act TCA 1997 provides for relief for employing a carer where the person being cared for is incapacitated by reason of physical or mental infirmity. Your statement of liability will confirm if your tax is overpaid, underpaid or balanced. The statement of liability then moves on to income chargeable to universal social charge. This section gives a breakdown of how universal social charge is calculated and refers you to panel 9 and 10 for a breakdown. We have a year-to-date calculator for anyone that would like to get a second opinion on the universal social charge and tax calculation on their statement of liability. This is the year-to-date calculator. You can check it out on this channel. It is called How to Calculate your income tax and universal social charge. Just enter your annual standard rate cut-off point here and annual tax credits here. Choose pay period 12 for monthly, 13 for 4 weekly, 52 for weekly and 26 for fortnightly. The taxable pay will be what's on your payslip plus any taxable Department of Social Protection payments received in the year. The gross pay is what will be on your last payslip. Now, just match the figure on your last payslip for 2024 to the result from the calculator. You can see here that our calculation reconciles with the Statement of Liability. We can also see here when we use the calculator to reconcile against this balanced Statement of Liability. In this case, we are entering the figures from the Statement of Liability, which is cheating a little. We are assuming this person is paid weekly, so we select pay frequency of weekly and then pay period 52, as that's how many times this person was paid in the year. If there was a period 53 in the year, then we would have used that. We chose cumulative tax, as we do in all cases for this type of exercise. We enter the taxable pay, the standard rate cut-off point, and the annual tax credits. We then enter gross pay for the USC calculation. We can see here how they reconcile, which proves the accuracy of the calculator. The 4-year time limits for a review of your tax. Statement of liability request must be made within 4 years after the end of the tax year to which the claim relates. You may currently request a statement of liability for the years 2021 to 2024. Overpayments of income tax or universal social charge. If your statement of liability shows that you have overpaid any amount of income tax or universal social charge USC, you will be due a refund. Your refund will be transferred directly into the bank account details on your revenue record within about 3 to 5 working days, subject to, of course, to our previous comments in relation to the processing time for income tax returns and when you get your statement of liability. Here is an example of how you will be informed of your statement of liability. It is important to check that your bank account details are correct. You can review and provide your bank account details in My Profile within My Account or when you are completing your Pay As You Earn PAYE income tax return. Otherwise, if there are no bank account details on your revenue record, you will receive a check in the post. Tax refunds for jointly assessed couples. If you are jointly assessed, any refunds will be paid to each person in proportion to the amount of tax each has paid. Example: Andrew and Maria are married and are jointly assessed. Andrew is the assessable spouse. In 2024, they paid €16,000 tax. Andrew paid €10,000 and Maria paid €6,000. After the end of the 2024 tax year, Andrew claimed a refund of tax in respect of health expenses for 2024. The refund due is €400. How the refund will be paid? The proportion of the tax paid by Andrew is 62.5%, which is €10,000 divided by €16,000 multiplied by 100. The amount of refund Andrew is due is therefore 62.5% of €400, which is equal to €250. The proportion of tax paid by Maria is 37.5%, which is €6,000 divided by €16,000 multiplied by 100. The amount of refund due to Maria is €150, which is 37.5% of €400. Underpayments of income tax or universal social charge, and what to do if you have underpaid income tax or universal social charge. Your statement of liability may indicate that you have underpaid income tax or universal social charge. This means that you owe revenue money for unpaid tax or universal social charge for the years you complete your Pay As You Earn PAYE income tax return. Reasons for an underpayment of income tax or universal social charge. There are several reasons why you may have underpaid tax, and we outline the reasons in this video. There are several reasons why you may have underpaid tax. We outline the reasons in this video here on this channel in the video called How PAYE Taxpayers Can Have an Underpayment of Income Tax. There are a few other examples relating to how PAYE workers can have an underpayment of income tax or universal social charge. Old age pensioners are automatically paid an extra allowance of €10 per week when they turn 80. That's in 2024. We have instances where a PAYE taxpayer who turned 80 during the 2024 tax year ended up with an underpayment, as revenue were not notified of the increase to their taxable income as a result of this €10 increase to their old age pension for part of the year. Scenarios where PAYE taxpayers exceed the income tax threshold for reduced rates of USC. If your annual earnings are below €13,000, you should not be paying universal social charge. But how are revenue to know how much you will earn in the year unless you advise them? If you advise revenue that you will earn less than €13,000 in the year and they put you on the reduced rate, and then your income exceeds this limit, you would be liable to pay universal social charge on the total income for the year in line with the USC rates. Thus, you will owe USC at the end of the year. The opposite scenario may also apply. If your weekly income peaks beyond a certain threshold, revenue may wrongly project that you earn at that rate year-round, causing them to charge you at the normal rates, and at the end of the year you may have earned less than €13,000 and revenue has charged undue universal social charge deductions, in which case you would be due a refund. This video here is about reduced rates of USC for medical card holders and people over 70, and more specifically if anyone in these categories exceeds the income limits within the tax year. This has happened to several taxpayers, and this video addresses the issues surrounding this situation for those taxpayers on reduced universal social charge rates and who exceed the income limit. How to settle underpayments. Information will be included on your statement of liability explaining how the liability will be collected. Example: Maria completed her income tax return for 2024 in January 2025. This has resulted in an underpayment of tax of €312. This will be collected by reducing Maria's tax credits over 4 years as shown here. Amount to be collected in each year: 2026 €78, 2027 €78, 2028 €78 and 2029 €78. The table here also shows the reduction of Maria's tax credits depending on how often she is paid. Reductions of tax credits. Pay frequency, the amount to be collected. If pay frequency is weekly, then the amount to be collected each week is €1.50. If the pay frequency is fortnightly, then the amount to be collected each fortnight is €3. If pay frequency is monthly, then the amount to be collected each month is €6.50. Here are examples of how they would appear on your statement of liability under treatment of result. Disagreements and Appeals. This notice sets out the details of what action you can take if you disagree with the result or wish to appeal the statement to the Tax Appeals Commission. Offsets and potential delays in issuing of refunds and statements of liability. I did say I would return to this issue. 1. You may have a historical tax year outstanding to file with Revenue. Revenue has become very efficient and at flagging outstanding years where there are underpayments of tax in Ireland. And if you are one of these individuals who have not dealt with underpayments, you will not be able to avail of a rebate going forward. 2. You may have an outstanding income tax return. Another reason why Revenue is not releasing you a rebate is that you could possibly have been self-employed at some stage and have not submitted all of your income tax returns. You will never receive a rebate until all outstanding income tax returns are up to date. 3. You may have an outstanding issue with your local property tax. If you don't file your local property tax return, Revenue would withhold any refunds being issued to you as you have not complied with the LPT filing rules. Another LPT issue comes with underpaying or not paying your LPT or local property tax. With any refund you are due being offset against your local property tax underpayment, as shown here on treatment of result. Where a repayment of tax is claimed within the relevant time limit for repayment claims, the repayment is available to be offset in accordance with Section 960H of the Tax Consolidation Act 1997 in the normal way. Where a repayment of tax is claimed outside the relevant time limit, revenue cannot offset any of the tax involved against any other tax liability of the taxpayer, as no repayment is due to the taxpayer. 4. You may be experiencing a Level 1 compliance intervention. Revenue is continuously issuing taxpayers Level 1 compliance interventions. This type of compliance check means they are regularly looking into the tax credits you are claiming, such as medical expenses, tuition fees, working from home relief, and more. It's important to always be vigilant when revenue requests these details, as it can cause long delays or even non-issue of rebates, as many people tend to ignore these queries. 5. There may be Department of Social Protection issues. You may have been in receipt of social welfare. However, sometimes the details on your revenue profile are incorrect. To fix this issue, revenue just require your statement from the DSP department so they can do the calculations for you and ensure you get your tax back, and maybe even more if you were taxed incorrectly on these payments. 7. You may be experiencing a general revenue backlog. In addition to the possible reasons above, the time of the year of your request may also play a role in your rebate release. If you are unaware, the second half and up to the end of the year is the busiest time for revenue. Without even considering the budget, the end of quarter 3 and all of quarter 4 play host to numerous important tax deadlines, including income tax, capital gains tax, capital acquisitions tax, corporation tax, local property tax, and more. So basically, your request is time of year dependent and may have nothing to do with the other 4 reasons. Panels 1 and 2 of Statement of Liability. Panel 3 of Statement of Liability for any deductions to taxable income prior to the income tax calculation. Panel 3 and 4 for a single person. Panel 3 and 4 for joint assessment couples. Other tax credits like rent tax credits will be listed in Panel 4. Panel 5 and 6 retained by you and reliefs. Panel 7A and 7B show positive or negative adjustments to your tax liability. Panels 9 and 10 show income subject to universal social charge and the amount of universal social charge deducted. The final page contains some very useful information about the Statement of Liability and also includes some very valuable links for further information, not least about flat rate expenses and the mortgage interest tax relief. Before I leave you for now, can I ask those of you that have not already done so to hit the subscribe button and also to turn on YouTube notifications for this channel. We have a video guide on how you can turn on notifications for this channel so you can get an alert every time we post a new video guide, as we have many more helpful pay, income tax and other work related guides and videos to bring you. It costs you nothing to subscribe, but could help you save hundreds or even thousands of euro into your hand on pay and tax. Go on, hit that subscribe button. Go on. See you next time.